Well, welcome back. In the last presentation on fixed income investing, we talked about the guarantees or investor protection that's available to you as an investor when you buy GICs, term deposits, have savings accounts, or buy federal government, provincial government, or corporate bonds for your portfolio. This presentation, we're going to talk a little bit about bond markets and bond pricing. So keep in mind, one of the earlier presentations, we talked about bonds, and so I could have a $10,000 bond. That's usually called the face amount of the bond, with a coupon rate of 3% and a maturity of 10 years. Now, at this level, the bond really works just like a guaranteed investment certificate or a GIC. We get our $10,000 back at maturity in 10 years. We get 3% every year as we hold on to that bond. So that's fairly straightforward. When you look at bonds, you'll see investors, and sometimes people ask the question, why would I buy a bond as opposed to a GIC? One reason is sometimes the rates are better, so we can find better yield. Particularly with larger institutions and investors, very rarely do you see them buying GICs. And one of the reasons is you can get a lot more protection. If you're managing hundreds of millions of dollars, you're not going to try to get GIC or investor protection that way. You're going to buy good quality debt. And if you've got federal debt and provincial bonds, municipal bonds, Crown Corporation debt, you can have millions in there and be pretty confident that you're not putting your investors at risk. But the other reason that institutional investors and sophisticated investors will buy bonds is because there's something called a bond market. And the bond market will provide opportunities for investors to maybe enhance yield, but also to provide liquidity before maturity. So keep in mind that in the guaranteed investment certificate or GIC term deposit world, for the most part, once you lock the money in, unless you're in dire circumstances because of health or other things, they'll almost never unlock that contract for you. So you're locked in for a period of time. But if you're a very large institutional investor like an insurance company or a pension fund or endowment, foundations, there's always a need for capital, and you want to have the ability to be liquid, to be able to get at your positions, to cash them in, to get a hold of capital if it's required. And certainly the bond market allows you to do that. So this is straightforward. Now let's look at an example. Let's say that I've got a bond that's, let's say, $5,000. And let's say right now I can get a yield of 6% on that bond. Now, the bond market is huge, like I said. In one of the initial presentations, it's over $157 trillion, 75% of total capital market stocks and bonds is bonds. And so it's a large market, and every day, every minute, every second, bonds are being traded. They're being bought and sold in the secondary market. Now, the secondary market is essentially all those securities, it could be stocks or bonds, that have been issued. We've got investors who buy new bonds, and then once they hold them, they can trade them on the secondary market after the fact. So what's going to drive the price of that bond in the secondary market? Well, one of the things that's going to drive the price of a bond is going to be the bond interest rate and prevailing interest rate. So let's say that this bond was a 10-year bond. So $5,000, 6% for 10 years. At the end of the 10 years, I get my $5,000 back. But let's say that at year 5, into that holding period of 10 years, I, for whatever reason, needed to liquidate the bond. I needed to sell it, get a hold of the capital, and use it for some other reason. And let's say at year 5, interest rates have gone up from 6%, and they're now 10% in this particular example. And yes, I know at the time of this video you can't get those rates, but bear with me. It makes the numbers easy for me in this illustration. So we've got 10%, 6% was our rate. What the bond market's going to do is they're going to go, well, and the bond market is other people who are buying bonds and are looking for yield, and they're going to go, well, I really don't want your bond. If you're getting 6% and I can get 10% today, why would I ever buy your bond? I certainly would not pay you $5,000. I wouldn't pay you, par value or your purchase price value for that investment. But I might be prepared to give you basically a discounted value on that bond. And so I'll say to you through the bond market, I'm willing to give you $4,110 for your $5,000 bond. So keep in mind, at the end of the maturity, we've got 5 more years left. It's going to mature at the $5,000 level. And so when I take a look at the difference between the $4,110 maturing at 5, so I've got this built-in gain here, and the fact that I'm getting 6%, that equates over the next 5 years to me getting 10%. And that really, in a nutshell, is how the bond market works on pricing relative to changes in interest rates. So you can see the exact opposite would happen. If we see that rates go down and you needed to sell your bond, well, you're in a better position. You paid 5, but you would demand a premium for selling that bond because you're selling a bond that's 6% that maybe prevailing interest rates are 4%. And you would not sell that bond unless you can get a premium to reward you for the fact that you are losing that yield. Now, this presents opportunities for sophisticated bond investors, and particularly pension funds, mutual fund managers, that kind of thing. They try to get enhanced yield by being aware of being able to trade to get additional yield. And so if you thought that interest rates maybe were going to fall, you might strategize and try to take advantage of this. If you thought that interest rates were going to go up, you would probably do something to limit this fluctuation on the portfolio. And I'll talk about how that works in a second. Okay, so that's the bond market. It's a secondary market for bonds. So you have a new issue. Brand new bonds are sold by governments or corporations. You buy it. Now you're holding it. For whatever reason you want to sell that bond, you sell it into the secondary market. And one of the things the market's going to look at is what is your interest rate relative to prevailing interest rates, and that's going to help to set the price of the bond. Now, that's not the only thing that impacts the price of bonds. So again, price of the bond definitely is going to be impacted by interest rates. And I'd say that probably interest rate would be one of the major drivers of that fluctuation for the bond. But there'll be other things as well. The other issue would be the term left in the bond. So in an interest rate environment that's changing, the longer you're holding onto that bond, the more the fluctuation is going to be either positive or negative. So if I'm seeing interest rates going up and I've got a long-term bond locked into a very low interest rates, well, you can bet your bottom dollar that bond is going to fluctuate dramatically to the downside because investors are going, well, there's no way I'm going to lock myself into what we view as maybe an historically low yield during times of increasing yields or inflation. And so it can dramatically impact bond pricing as well. So the term. The other thing that can impact, obviously, the value would be credit quality. And so to the extent that you're buying lower quality bonds, the fluctuation will be more pronounced. The higher the credit quality, the less the fluctuation. So again, you can see in these 3 criteria the opportunity for bond investors, and particularly pension managers and mutual fund managers, can exploit these to try to either enhance yield on the portfolio, or they might change the portfolio to reduce risk. So as an example, if I thought that interest rates were going to go up, if I thought interest rates were going to go down, and I had a crystal ball that was telling me that, and I wanted to maximize the profit I'm going to get on my portfolio, I'm going to lock into a long-term bond. And I may even be a little bit aggressive in credit quality and reduce credit quality, so that if we see interest rates fall, I'm going to maximize the swing on the upside on that bond portfolio or that specific bond in my account. Now the reverse is true. If I thought that interest rates were going to start going up, and we know that there's an inverse relationship, a teeter-totter between interest rates and bond prices, now I might be concerned about that bond trading at a discount. And so what I'll do is I will shorten up the term. So I won't lengthen the term, I'll shorten the term. I may even actually go into, so another issue that impacts bond pricing is geography. So I might change geographic regions so that I might say, well, I don't think the US is a marketplace to be anymore because interest rates are going up, or Canada, but there's other areas where maybe interest rates will be falling. And so I can trade against bonds in different geographic regions to protect myself. So Again, fairly straightforward or rudimentary. There's a lot behind these particular variables, but I'll give you a basic idea that when you look at your statement, if you buy an individual bond and you go, I thought this was like a GIC, I have a maturity value, an interest rate, and a term, and yet when I look at my statement, my bond looks like it's got less value than what I paid for it, and you're wondering why is that? Well, it's because bonds can be sold at any time in the secondary market. Not an issue to you if you're just going to hold on to your individual bonds to maturity. Now, in a future video, we're going to actually talk about how do you go about buying an individual bond and how bond portfolios are managed. Typically in Canada, most bond portfolios that are managed through pension funds or mutual fund managers. They're not typically done through retail investors. Most retail investors, if they have individual bonds, are very passive with them. They'll buy the bond and just hold them to maturity. They'll stagger the bond maturities over time.